Welcome back to the Isn't That Rich podcast. I'm your host, Jill Franks.
And I'm your host, Ashley McVicker. Today's episode is one a lot of homeowners will want to hear, especially if you've been thinking about making some big purchases, doing some home upgrades, or just wanting to be smart with your equity.
Yeah, so today is all about a HELOC, which is a home equity line of credit. And we have the perfect guest here today to talk all about HELOCs and break that down.
Yes, so the last time she was on our podcast, we talked about refinancing, and today we're talking about HELOC, like Jill said. So welcome on one of our mortgage lenders, Taylor Abney.
Yeah,
thanks for having me, guys. I'm excited.
We're so glad to have you. You're so fun.
Yeah. So I guess, Taylor, for those of our listeners who don't know what a HELOC is, maybe you could explain that for us a little bit and just kind of tell us about why someone would want that.
So a HELOC is a line of credit that you can take out on your home. Usually people take it as a second mortgage, but sometimes people just take it as their first. It is a line of credit that is usable and left open for 10 years. So you can pay it down and use it over a 10-year period on your home. So it's different than just a traditional mortgage where if you do a cash out and you get all the money at one time and you pay it over time, this one you can pull out, pay off, and reuse again.
So, okay.
You said a lot right there, and Ashley and I are both like, ooh.
Okay, so when I have thought about a HELOC before, and I remember when I first started working here and we had all these ads about HELOCs, I'm like, Jill, what is this word and what does this mean and all these mortgage things? So you're basically taking out the equity that you have built up in your home.
Right. You're taking out the equity that you have built up in your home. And we can loan, if you have a first mortgage, we would take that into account, and then we can loan up to 90% of your home's value. So if you have a first mortgage and you owe some on that mortgage, and then you have your appraisal and we're like, okay, you've got, X amount of dollars left that you can take out for a HELOC. It just kind of gives you, a lot of people like to have it as a cushion in case they need anything, life events, things like that. So,
well, Tom and I just were doing some work on our house. So we need a new roof. We needed our deck replaced. So there's lots of things that are going on right now. And so instead of using cash out of our pocket, would HELOC be an option if we've built up a lot of equity in our home?
Right. Yes. So a line of credit would definitely be an option. It's a really good option for people too. It's got a lower interest than, charging things on a credit card or things like that. It follows the prime interest rate. So it does change, the interest can change monthly based on where, the prime interest rate is, but it's definitely a good option for people to have in order to do home improvements, and then pay themselves back, and then say 5 years down the road, you're like, hey, we need to do this, this, and this. It's definitely a good option to have.
So to me, and I've been talking about this at work, I feel like it's kind of like a secret savings account, like within your mortgage.
Right.
Like that's like the best way to describe it. You've built up this cash. And also you said two things at the beginning. So you said a HELOC, and then I think you said a cash out.
Yes.
Is that what you said?
Yes.
So what's the difference?
Okay.
And maybe explain more.
A cash out refinance would mean, hey, we need some cash now and we want to term it out. We want to term our loan out. We want to do a 30-year, a 20-year, a 15-year, a 10-year.
Does that mean just like start over kind of?
It could be a second mortgage. It's just, we give all the money to you up front.
Okay.
So we're like, hey, here's your 30 grand at closing. And now we've termed it out to where you will pay this loan off in a certain amount of time. As a line of credit is like, you can call the bank and say, hey, I need $10,000 transferred to my checking today. You don't have to take the $30,000 all at one time. You can take it a little at a time and then, pay it off, and then you can reuse it again. So whereas the cash out refinance, it's all done after one time.
So
we give you a check at closing and it's done. You can't ever use it again unless you want to do another loan. Whereas the line of credit, you can use over and over again for the 10 years as you pay it down. So it is kind of like building your savings account up,
Okay.
using a savings again, and then, doing it back and forth for a period of time.
So line of credit, it kind of makes me think of a credit card.
Right.
Like, so maybe you have a 10,000 limit
Right.
on your credit card, and that's what you just keep
You
paying
keep
it down,
paying it down and
but it's a
reusing.
lower interest rate.
Yes,
Okay.
definitely the lower interest rate. Whereas we're seeing, I saw 32% on a credit card the other day. So we have been doing lines of credit for people. I have been doing, lines of credit for people recently to pay down debt, because it's definitely more beneficial to pay a 7.5% than to be paying the 20 and 32%.
Right.
So
I read about that the other day when kind of doing research for all of this, that people are paying so much money on credit cards, and multiple credit cards at that.
right.
And so can you talk about like debt consolidation with those things and rolling that into a HELOC? And if I'm saying that correctly, I don't even know
Right. So
that option that's available to people to help them with their debt.
So I've actually had a lot of people recently that want to roll all their credit cards into a line of credit, because it's just so beneficial, and it's cutting their monthly payments down dramatically. I do always tell them, if we're going to pay off your credit card, don't close your credit card, because that's going to hurt your credit. People don't think about that, but that is going to hurt your credit. But let's pay them down so your monthly payment is less than, what you're paying now on credit cards. And if you've built that equity up in your home, why not use it instead of just paying, interest on a credit card monthly? It's definitely a better option if they have the equity in their home to do it.
Absolutely.
So I have a question for you. So just take our example. Somebody might still have a current home loan, and I think about our situation. We refinanced into a super low interest rate for a home loan. So is this a HELOC completely separate, or would getting a HELOC change the interest rate in my original loan? Because I think that's a misconception too. A lot of people might have.
So it's a completely separate loan. If you have a first mortgage on your home, we would not touch that. So it wouldn't mess up your interest rate, wouldn't mess up anything. It is a second home loan. Now, there are people who own their homes outright who just like to have a line of credit
for extra cash.
Right.
So they can still just take it out even if they don't have a first mortgage?
Right. So if you don't have a first mortgage, you can have a HELOC, and you can, I've had people buy investment property. I've had people buy their vehicles with it. Just as a better interest rate. So we do have a lot of people that have paid their first mortgage off too, and they're like, I just want a cushion in case something happens.
Yeah.
I need that extra bit of money just to open it up and take it. They may never use it. I mean, it may sit at a zero balance, but it is a cushion there for them, with the 10 years to use that for anything that comes about. So
Okay, so when you say that, this is how my brain works.
okay.
Someone's paid off their mortgage.
Right.
They don't owe the bank any more money. They do a HELOC. But they're not taking any money out until they start spending, correct?
Correct.
Okay.
Yes.
So in my head, I've been thinking a HELOC is like you take $10,000 out of your paid off mortgage, and now it's available for you, and you're just spending it. And then
right. So
it's just flip-flopped, I guess, in my head.
It's available anytime, you want to use. And what we do is you pay the interest on what you've borrowed monthly. So if you've borrowed, the $5,000 off of your $30,000 line of credit, you're going to pay the monthly interest on that, and 0.5% of the principal. So I think you do have to be a very vigilant person on paying it down. I'm not going to lie. We have a lot of people that have maxed out their lines of credit, kind of like a credit card, and don't pay it down. Because if you look at our payment method on how we require you to pay it down, you're not going to pay it down.
It would just be paying that interest.
It's just paying that interest and then 0.5% of the balance. So you're not paying a significant amount to pay it down monthly. We can offer it, if they qualify, we can offer it to anyone, but I always sit there and I tell people, are you going to pay it down? Are you, are you going to max it out and then for 10 years you're going to just be paying interest only? And then when it balloons at the 10-year mark, are you going to have the money to pay it down? Right. I always tell people, like, we need to do a figure when you take out $5,000. We need to figure out how much you need to pay to get it back down to zero if you're going to use it, because you don't want it sitting there for 10 years and paying interest only on it.
Right. And people, that would be a huge misconception. Like, just like a credit card, if you're only paying the minimum payments, you're really not paying down that big bulk of
You're never going to get out of it.
Yeah. It's just an endless
and then
cycle.
It balloons. Then after 10 years, you can renew it if you qualify for it. But after that 10 years, you don't want that big balance just sitting out there where you've wasted all that money on interest. So I do try to figure with people, hey, you're paying, if they're doing debt consolidation, hey, you're paying this much on your credit cards a month. Let's pay your credit cards off and then throw that much money back. If you can afford that, throw that much money back on your line of credit and pay it back down super fast and then have that open. So I do like to sit down with people and discuss, how to pay it back down, because I don't want to see it hanging out there.
No.
Maxed out.
Yeah. Question for you about this. Is there any stipulations on how you can use your line of credit? So, people you can pay your credit cards off. You can is there any stipulations of how you can use this line of credit?
Not that I've seen. I've had people purchase investment property. I've had people, I have a lot of people right now that own their own home, that are either like downsizing or selling their home. And they're like, hey, can we write a contract on a new home and basically do a line of credit on our existing home and buy that new home in cash and then turn around and pay it off? And I'm like, that's great. Sure. Let's go for it. Yeah. And they're like, we may only need the line of credit for 3 months. We may need it for a year, but we want to buy this home, do some work to it, buy it in cash. And then when we sell our home, we want to pay it off. So I have a lot of people doing that right now. I have a lot of people with the credit cards right now. I just had a couple that paid their child's tuition bill with their line of credit for college. I've had a lot of people, I went down south to school. I have a lot of people asking me, that I went to school with about their kids' private tuition, their private school tuition, paying that out of a line of credit. So a lot of different options to where they're not even using it to better their home.
Yeah.
Of course that was their original plan, was to better your home with it, but there's so many different options for it.
Well, that's great. So you don't have to take it out if you decided, like, I want to spend this on a new kitchen remodel. And then you're like, I just don't really think I want to do a kitchen remodel right now. We have something else come in. Maybe a medical bills, like I've seen that, or the credit card, all of those things. So, and
you can close it at any time. So if you're thinking, oh, hey, I did this, I'm not going to use it, this is bad, like I don't need it out there. I've had people like
freak out,
sitting out there. I don't need this much money, just
available.
Pull it. You can close it at any time. So they can come in and say, hey, we just want to close our HELOC. And that's completely fine too. You don't have to leave it open for the 10 years.
Okay. So it's not like when you get a credit card and you close that credit card, it dings your credit.
Right. No, it's not going to ding you. So.
Okay. And it's not like you pay it off and it automatically closes. You have to physically request.
Right. And that's what a lot of people don't know. They actually call and they're like, well, we paid it down to a zero balance. Unless you sign our form that closes your line of credit, then it doesn't close. It's open. So that is a misconception too. I think people are like, well, we paid it off, it's done. Well, you paid it off, you can still use it for the term of the loan. That's the whole point. That's what we want you to do. We want you to pay it down to zero and then use it.
Use it again and again.
Yes.
That's so great. So what does someone need to qualify for a HELOC? Is it based on their home value? Is it based on their credit? Like, what is this based on?
So we still look at debt to income. Of course, we want to make sure that you can qualify based on debt to income. Usually, I believe we want to stay around the 40% mark on debt to income. So we definitely make sure you can qualify, you can hold the loan, and then we appraise your home. And we see what the value of your home is. And then we take, if you have a first mortgage, we take that off of what we can loan, but we usually look at about 90% of the appraised value and come back and tell people what we can offer them to do a HELOC. You know, some people don't even want 5% of their home's value. They have a number in mind of what they want. I've never really, I don't think ever done the max out of like, oh, hey, you want your first mortgage plus whatever you can take to get to 90%. Usually, it's a smaller amount on a HELOC. You know, a lot of people want under 50,000. So it makes it easy. If we did a mortgage a year ago, usually we can use the same appraisal unless they're like, my home's gone up in value. We can use the same appraisal. We can do a quick letter search if it's under 50,000 at the title company, which is super quick, easy, and cheaper than doing a whole title search. Usually it runs less than $200 compared to, you know, 1,000-ish. So it's pretty quick. I tell people if we have a recent appraisal and you want to use that, usually we can do it in like 2-ish weeks.
Wow.
People want that. You know, people want it done so much faster these days. And usually if they're thinking they need a line of credit, they need it for something and they need it quickly and they don't have time to wait. So
is there, so you said, you know, minus their mortgage loan up to 90%, is there like, say, I don't know, do you have to have a certain amount of equity built up or there's not really?
So usually, yes, I tell people, I'm like, I hope that your equity is there. But a lot of people are like, well, I just redid my kitchen. I bought the house a year ago. I redid my kitchen. I think I haven't paid a lot on my house, but I think my house has gone up in value. Sure. And I think we've seen that on all the houses in this area.
So it's like appreciated value.
Right. The value of houses in the past 5 years in the vicinity of Southern Illinois has gone up dramatically. So even if you haven't, you know, put a ton of money into your house. I've told people, I was like, you would be surprised if you come back a year or two later to find out you have more equity in your home than you think you do.
So this is something you mentioned that when you have a HELOC, you only pay on the interest of the HELOC. How does that interest rate fluctuate? I know you mentioned prime. So is it an adjustable rate? Yes. How does that work? Can you explain that a little bit?
So a lot of people have seen that did lines of credit 5 years ago. They saw it go from 4% to right now it's at 7.5%. So it can change monthly, which is crazy for some people because they're like, well, we were used to that 4.5% payment and it jumped 3%. So
in a month.
Okay.
It does vary like credit cards.
It does vary. You know, I don't think it would ever get as high as a credit card. So it's beneficial in that way. But from month to month, you kind of have to worry about, well, what if the interest rate spikes? My payment, my interest.
Can I afford it? Yeah.
Right. Can I afford it? And, you know, to be honest, we approved a lot of people based on those lower interest rates. And then people came back when they went higher and said, well, I can't afford this line of credit payment. So that's when we kind of look to term them out so they can start paying it down, get a fixed interest rate, and pay it off. So we have done that for a lot of people when the interest rates went up, and we can do that at any time too. If you're like, hey, I can't get it paid down, we can go refinance it for a second or even a first mortgage if they don't have it. Give them a term, give them a principal and interest payment and help them to pay it off. It is a scary thing to not know that your interest rate is not fixed. So that's why I tell people you have to be very vigilant on paying it off. It is a line of credit. Like you should pay your credit cards off monthly. Things you should do. This is one of those things that you borrow the money, you should pay it off.
As soon as you can.
Right. Yeah. But it does readjust every month based on where the Federal Reserve has prime. So it is a little scary. I mean, to think I could wake up and it be
my payment's
9% or whatever.
Exactly. Yeah. And then I don't have the funds to pay that balance at that much. I had it at 4%, but I can't make that payment. So I've had a lot of people close their lines of credit out recently as well. And we've taken them to a mortgage to where they can just pay it off and be done with it.
That was my next question is like, so what does that look like when you say term it out? That means since it's a HELOC, it's a line of credit based on the equity of your home, it would move into a mortgage.
Right. So they could either, if they had a first mortgage, they could refinance and put that in there. A lot of people don't want to touch their first mortgages because they had a low interest rate that they got at some point.
So it would change the interest rate on your first mortgage?
It would.
If you had
you added it in there. Most people, we just do a second mortgage. It ends up being an adjustable rate too, but the rate only changes every couple of years.
3 years or something, yeah.
So at least it gets them to pay it down, gets them in a fixed payment to where they know this payment's not going to change for 1 year, 3 years. So there are ways to pay it down if you're like, oh no, what did I do?
Right.
What did I get myself into? I thought this was like a credit card. I could go, crazy on it. And then now I can't pay it down. Now my interest rate, I can't afford it. So there are options. But I always like to tell people that. And when I'm approving them for the lines of credit, I like to look at their debt to income and I'm like, hey, you're close. Like you're really close. If the interest rate were to rise 3%, can you do it? I mean, because you never know.
Yeah. Things change so quickly.
Right.
And so your recommendation, once it goes into that second mortgage where maybe they have like a 3-year fixed term, pay off your second mortgage.
Right. Yes.
Like
pay it off. Be vigilant about paying it off.
Okay.
And there are people that I've told like, hey, this line of credit has been maxed out, for over a year and you're not getting anywhere with paying just interest payments on it. And they do feel stuck. They're like, I just can't get out of it. I'm like, let's look at a second mortgage.
Right.
Let's
There's options.
Yeah, there's options. I try to look at the lines of credit that I have at least like once a year to see the people that have left it at their max for a year and kind of reach out to them and just ask them, are you leaving it at your max for some reason? Can you not pay it down? Do you want to try to do a second? Because sometimes people don't want to come to you and say, hey, we can't get out of it. Like the interest rate is crazy. And so that's when I'm like, let's do something. Let's get you on a better plan. But people sometimes are like, oh, it's like a credit card.
Yeah.
So we can use it, max it out, and then they're like, we're stuck again.
Yeah. I think that's so good that you call people because people forget, even though they might have understood it at one time, like when you're in it and you feel trapped, you might not know your options. So it's so good that you do call.
Right.
Yeah. Tell people because I
you try not to make people feel uncomfortable.
Yeah.
I mean, you want to make them feel like, hey, we care. Let's take care of this. Like we got rid of, if you had debt or you did something to get out of it, like let's get you out of this one.
Yeah.
It's okay. Like there's options to get out of it at any time.
Are there any risks or red flags people should consider before getting a HELOC?
I do kind of, when I pull credit reports, I do look at their spending habits on, revolving credit.
Sure.
And I do talk to them about the revolving credit. I mean, do I think it's a good thing to pay off the high debt? If that's one thing you want to use it for, of course. I'm like, there's no reason to pay 28% when you can pay 7%. I mean, there's no reason to do that. But I do kind of talk to them like, hey, it looks like you've maxed out all your credit cards. Like you don't want to do this. You don't want to do this because this is another line of credit. I mean, you don't want to max this out. That's usually my biggest red flag is just talking to people about that. When I pull their credit reports and see that, oh, you have 5 credit cards and you've maxed all of them out. Like what? This is beyond you using it to better your home, better yourself. Like what can we do? It's crazy. Like I said, like it's crazy with loans right now, but it's still good to talk to anyone that comes in. When I pull their credit report, I'm like, you don't want to stay like this. Like we want to get you out of it and help you do better and help you buy that better house down the road or, that investment property so you can earn extra money. I mean, there's just so many different things. But that's usually my biggest red flag is when they come in for a line of credit. They're like, we have equity in our house. And I'm like, oh, you have 5 credit cards that you've maxed out.
You also have like all this debt.
Yes, we need to figure out how this is not going to happen again, how you're going to pay this off. And then if you can afford to make these payments, that's why I usually tell people, let's continue to make those payments for a little bit and pay this back down while we can. Right. Like chunk your money towards paying it down. So then you do have a cushion.
Yeah.
So
we talked about a HELOC compared to like your home, your cash out refinancing.
Right.
So what is the difference between a HELOC and a personal loan? So people go get personal loans at a bank all the time.
Right.
What's the big difference?
So our unsecured loans, I think, are running, we're doing a lot of the Quilla loans, but I think I've seen people get 11% all the way up, I think, to like 18%.
Yeah.
So, the interest rate, of course, is going to make a huge difference. We do not do unsecured debt consolidation loans. So that's another option. If somebody's coming in and saying, hey, we want to pay off debt or we want to pay off a student loan, we don't offer the unsecured for those.
And unsecured is just mean you have no collateral.
No collateral.
Yeah.
So like if we were to loan $3,000 and we never saw you again, then the bank would lose the $3,000.
But if you did a HELOC, we have the collateral,
yes,
so we can.
Yes. So I'm not a huge unsecured loan fan, because if you don't have anything to hold on to, I just feel like there's not something good. Not saying we won't do it, but it's just definitely like to have the security of something, a car, a home, something to loan on.
Yeah.
Well, and honestly, I'm thinking about it. If I needed to do debt consolidation, I feel like, and I'm just saying this, I feel like it would make me want to pay off my stuff more if I knew it was tied to something I actually owned.
Right.
Because then you're thinking, what if I want to buy a bigger house someday? What if I want to do this?
Yeah.
You know,
there's more
like I can't lose this.
Yeah. If you can pay your credit cards off and know that they're paid off, and then you're like, okay, now it's on my home. That's why I'm usually like, let's pay this down and then have that cushion if you want to do something else. So
I want to talk about, so we just had an episode with Shelly Kane about like all the things you could fix up in your home to improve the value of your home, to then sell it for more money. Are you seeing that people are doing that with HELOCs? Like they will take money out and, completely redo their kitchen or their bathroom or whatever, paint the whole house, because you can use it for whatever you want to use it for in your home. And then are you seeing actually after people do that, the appraised value go up on their home?
Yes. So I'm seeing lots of people redo kitchens and bathrooms and do updates on those. And a lot of the people that I'm seeing pull the lines of credit to do those things are wanting to turn around and sell it to buy a larger home. So I am seeing it. And then I'm seeing a lot of the big ticket items, the roof, the windows, the siding, things like that. So it's definitely beneficial to take it out to do those things, because
that's what I'm thinking.
Yes.
Rather than take your cash out of pocket.
Right. If you had, savings, and let's say you were saving, you're just a saver in general, you're 6 to 9 months saving for your living expenses, but also to save to maybe buy a bigger home or whatever.
Right.
I mean, it just seems like a no-brainer to pull that out, that equity, and then it adds more value to you're going to make money in my brain.
Make money. Yes. Well, like I tell people, I'm like, you don't really, if you have investments, you don't want to pull your money out of investments for something like that. I mean, you don't want to pay the taxes on it. I mean, it's just more beneficial to take the home equity line of credit. Well, then at the end of the year too, you're getting a form from us for the interest that you can take off of your taxes. So
I didn't think about that.
So that's definitely a plus too. I like to tell people to keep their reserve of cash if they have it. I play a lot of different scenarios with people. Like if they come in and sit down, like we, look at if they have investments, if it's cheaper for them to pull their investments, if it's cheaper for them to do a savings secured loan. I mean, if they have money in their savings and they're like, well, should we just put a hold on our savings account and take a savings secured loan instead of doing a line of credit? different options. But it's definitely cheaper to do it that way. Unless the interest rate just skyrockets, which I don't think it will go much more than it is right now. I think we're at a steady pace and hopefully a downhill. But it adds so much value to your home. I mean, redoing your kitchen and redoing your bathrooms and your flooring too, it adds so much value. So
Shelly said on that last episode too, buyers nowadays are so picky that if you're not move-in ready, a lot of buyers don't want to do any work.
Right.
And so that just makes your home more appealing, will sell faster if you do list it. So I think that's
right. And then you're paying off your line of credit. You know, you're redoing your home, you're listing it, you're paying off your line of credit quickly. So you're barely paying interest on any of that money that you've just borrowed to up the value of your home. So that is what I'm seeing a lot of. I am seeing people taking it out, do some updates, sell their home, or turn around and pull the equity out and buy their new home per se, because you're buying it in cash. You're a cash buyer, which is, people are looking at you like, oh yeah, you're a cash buyer. We'll sell it to you before we'll sell it to somebody that's doing financing.
right.
They're turning around, selling their home, and then just paying it off. Right. So, I mean, that is what I'm seeing a ton of.
Seems like a great idea to me.
I
I'm like,
know,
I
right?
just built a home. I'm
What
going to do it.
improvements do we need? No, just kidding.
Yeah.
So if somebody's listening to this and they're thinking maybe I should look into it, what should their first step be?
I think just to call any of our lenders. Usually we just ask them, you know, how much they purchased their home for, what they have in it, things like that, what they think it would appraise for, look at their debt to income, look at what they're wanting to do with the funds, you know, if it is home improvement, debt consolidation, paying for schooling or doing any of those things. I think it's just something that you talk about the different options and then you see what fits best, because some people, a line of credit doesn't work, and a second mortgage or a first mortgage, doing the cash out refinance all at one time where we give you a check and then you just start paying it off. That works better for some people than doing the line of credit. So I think it's just looking at the individual person, talking to them and seeing what their life plans are, what they plan on doing, if they plan on staying in the home, if they're good about paying down things. I think it's just a lot of different scenarios for a lot of different people. So you just have to look at the person that you're lending and just talk different options out with them.
Yeah. That'd be so helpful.
Yeah.
I mean, a lot of people hesitate to get in touch with the loan officer because they're just worried that, we have to commit to something, but people don't realize, let's just walk through these scenarios.
Right. And then I just ask questions like, are you good about paying down? You know, like I said, when I pull your credit report and I see your credit cards, I'm like, maybe you're not good about paying, you know, revolving debt down, but maybe you're good about paying your installment debt down. So let's do the cash out refinance instead of opening a revolving door for you again. So I think it's just talking to the individual and seeing what fits their needs. And that's with all of our loans. You know, different people do better.
Different things.
With different things. So
true.
Yeah.
Really good.
Yeah, this is so fun, Taylor. If there is something, is there anything else that you would want to leave with our listeners about a HELOC? Or
I think right now, it's a great option to look into if you have the equity in your home, just to revamp your home, you know, to look at if you need new windows, new siding, new roofing. Now is a great time to do those things. I feel like the cost of those things have gone down. It's a great time to look at paying debt down too, because I know a lot of people are struggling with debt. So if you do have the equity in your home, it's definitely something to think about in that sense. Because you're not, you know, you're paying such a high interest, you're not being able to save any money. I think it's a good thing for people to look at right now too, with the new school year getting ready to start up, needing some extra money. Maybe you're sending your kids to college, you need that tuition payment. I think all of those things are good options to come right now and see what we can do.
Definitely.
Yeah.
So good.
Well, thank you so much for
Thank
being
you,
on.
Taylor.
Thanks for having
Hey,
this
guys, I
conversation.
appreciate it.
Yeah, answered some of my questions for sure.
Hope so.
So Taylor, if people are wanting to reach out to you about maybe getting a HELOC or a cash out refinance, how can they reach you?
They can call me at the Harrisburg branch. They can email me, or they can call my cell phone, text me. Text messaging is really good. I am pretty available. So,
Well, we will put all of your information in the show notes.
Definitely. Yes, do. I am in the branch Monday through Thursday, and then Friday I work from home, but I'm available to reach most of the time.
Perfect. Well, thanks for being on.
Thank you.
We'll see you guys next week. So Jill, where do we go from here?
Be sure to check out our show notes for this episode, and also be sure to follow us on social media and subscribe to our newsletter. We'll see you next week.
See you next week.